Welcome to Factful Finance, where we take complex finance topics and break them down in a way that empowers you to make better money decisions. Ever wondered why some stocks seem to go up and down more wildly than others? Or how some investors seem to have the secret sauce for navigating the market's risks, while others flounder? Well, today we're diving into one of the key concepts that can help answer those questions: beta and systematic risk. Let me paint a picture for you. Imagine you're an investor like Noah, who's been eyeing a stock for months. He knows the market's a bit of a roller coaster, but he's looking for something with high returns. Problem is, Noah's also trying to avoid the stomach-churning drops that come with volatile stocks. He wonders, how do I know which stocks will rise and fall with the market, and which ones might be more stable? That's where beta and systematic risk come in. So, let's break it down. What exactly are beta and systematic risk? At the heart of it, beta is a measure of a stock's volatility compared to the broader market. Think of it like a sensitivity meter for risk. If a stock has a beta of 1, it moves in lockstep with the market. If it's higher than 1, it's more volatile than the market, and if it's lower than 1, it's less volatile. But what does this really mean for you? If you're like Olivia, who's building her portfolio, understanding beta helps you choose stocks that fit your risk tolerance. Want high returns but can stomach the ups and downs? You might lean towards stocks with a beta above 1. Want more stability and less risk of big drops? Opt for stocks with a beta below 1. Now let's take it a step further. Systematic risk. This is the risk that affects the entire market, not just one stock. It's the unpredictable, external forces like interest rates, economic downturns, or geopolitical events that no individual company can control. And guess what? Beta helps us measure how sensitive a stock is to these broader market changes. So, when the economy sneezes, systematic risk is what makes the whole market catch a cold. Here's an example. Liam, a savvy investor, holds a stock with a beta of 1.5. He's seen great returns when the market rises, but every time there's a dip, his stock seems to fall harder than the rest. Why? Because that stock has a higher exposure to systematic risk, meaning it's more sensitive to market-wide events. So, how do you use this information to your advantage? Let's talk strategy. If you're aiming to minimize exposure to systematic risk, you might consider diversifying across sectors or holding stocks with lower betas. If you're more of a risk taker looking for high returns, leaning into stocks with higher betas might fit your style. But let's keep it real. This is all about balance. While you might be tempted to go all in on high beta stocks for potential rewards, always consider your long-term goals, market conditions, and risk tolerance. Now I want to throw something at you. Here's a quick scenario. Let's say you're building a retirement portfolio, and you're eyeing both tech stocks with high betas and some utility stocks with lower betas. You might want the growth potential of tech, but you also want the stability of utilities. Here's where beta can guide you. A balanced mix of higher and lower beta stocks might give you the risk-reward profile that suits your goals. Which brings us to the big question. Should you focus more on beta or systematic risk when investing? In reality, they're intertwined, but knowing how much risk you're willing to take, paired with a solid understanding of beta, will empower you to make better choices. Don't ignore the market forces. Systematic risk is powerful. It's not just about what a stock does, it's about how it reacts to the world around it. Now that you understand the concept of beta and systematic risk, let's take a quick look at how this plays out in real life. Emma, for example, tracked the performance of her stocks during the last market downturn. The stocks with higher betas didn't perform as well, while her lower beta stocks provided a cushion. By adjusting her portfolio with this knowledge, she was able to stay more stable through the chaos, making sure her long-term strategy stayed on track. Before we wrap up, remember this. Beta and systematic risk aren't just academic concepts. They're tools to help you navigate the real world of investing. By understanding these principles, you're armed with knowledge that helps you make informed decisions and manage your portfolio's risk. If you found this video helpful, you'll want to check out the next one. We're diving even deeper into the world of market strategies. Click the video on screen to keep building your financial knowledge. And if you're ready to take your finances to the next level, hit that subscribe button so you don't miss anything. This content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance.